What a time to be in the stock market. Holy smokers, this ain't no dang jokers. VIX is exploding higher. We have extraordinary moves in the market. Folks that are new investors to the market are going through their first stock market crash, their first big, massive volatility spikes. And some people are like, I don't know how much more I can take of this, okay? We're talking about the crash of your lifetime. We're talking about a situation here in which the market remains absolutely incredible. It's a very important message I put out to my private stock group members last night. I want to take you guys through what I said there and why I said it, because I think it's very, very important. From there, we're going to talk about the VIX input to call ratios, where those are at, and what that means for how close you are to an actual real bottom on the stock market, okay? From there, what we're going to get into is the biggest daily changes in Nasdaq history, because just yesterday, we went through the second biggest upward day in the history of the Nasdaq. In the history, incredible historic day, right? And we're going to look back and we're going to find, when you had one of those big upward days, did it mark the bottom of a market, or was there actually a lot more pain to come? That's going to be very important, what we're going to go through there. Then we're going to talk about, a lot of people think they're going to time this market out. They're going to try to get it perfect. I want to go ahead and talk about that. And if you miss the best days in the market, what your returns are like, okay? From there, I want to react to this video. We're not going to react to the whole thing. It's like a 20-minute clip. I just want to react to the first 5 minutes of it. Because this gentleman from Citi, very important individual at Citi, says don't buy the dip. I want to go through his points on why not to buy the dip and share my opinions and perspectives. Then we're going to react to this one. Big Tech digs in on AI capex as tariff whiplash. We'll react to that one. And maybe we put the financial crisis on hold, but we still get to have a recession. Josh Brown. Looking forward to reacting to that one. By the way, busy times, folks. I appreciate you being here. I appreciate you going through all this craziness with me. It's fun times, folks. And all I need from you is for you to smash that thumbs up button down there. And that's it. If you want to subscribe here to the channel, you can certainly subscribe. We're getting close to, 90,000 subscribers here on the Reaction channel now. So I appreciate each and every one of you for being here. Additionally, if you're looking to apply, join my private stock group, get access to all my best course curriculums, access to my private Discord chat, access to 1000xstocks.com, the premium investing software I use on a daily basis to figure out if I'm getting great deals on a stock or a bad deal. That will be a pinned comment down there. You can click on that, fill out a form, okay? Alrighty, so let's get into this. This is the message I sent to my private stock group members last night. I said, someone said something that I thought would be worth addressing from today's video, and that was yesterday's video on the main channel that I put out, right? I said, they said something like, Jeremy, I thought you would be more happy, excited recording today's video, given that it was the second best day in Nasdaq history. And I guess because I was pretty stoic in that video, people were like, why aren't you happy, super excited? It was the biggest day in the history of the public account yesterday. The public account was up, gosh, I don't remember, $335,000, some crazy number, just ridiculous, right? Never mind, plus all my other portfolios. And I said, my thoughts are, why would I be all super happy and excited yesterday? Why would I be? One, if I get all emotional about upward moves, then I'll likely get emotional about downward moves. Emotions and money are like oil and water. They don't mix. As somebody that's been in this game now 16 plus years, and somebody that's gone through several crashes and countless corrections, right? Remember, I got started in one of the worst crashes in history, the great financial crisis, right? From there, we had a lot of major corrections over the coming years, a lot of big corrections, including 2018, that was nearly a stock market crash at the end of the year. Then we had the 2020 crash. We had a crash in 2022 where the Nasdaq fell 37%, peak to trough from where it peaked at in 2021 to where it troughed at in 2022. And now we're going through this thing. I can just tell you, you don't want to get emotional. You don't want to get emotional when you're having those upward days because, man, you're going to get emotional on those downward days. And the worst thing you can do in the stock market is get emotional about all this stuff. And I understand for a lot of newbie investors, like you're in your first year or two or your first few years, a lot of those individuals get very emotional about the market. It's just going to cost you money. I don't know any other way to put it. It's going to cost you a lot of money. The more emotional you are about this game, the more money it's going to cost you. You just got to be stoic in this game. And that comes with experience also. As you get more experience in the market, right? For me, there's really nothing that could happen. The S&P 500 could go down 27% tomorrow. Means nothing to me. I'm just at that place that It is what it is. You've been playing a game so long and you're so experienced at it, there's nothing that phases you. The S&P 500 go up 27%. Like, just a ridiculous move that's never happened before. And at the end of the day, once you get experience in it, like, you know how to handle it. You're like, okay, this is what we got. This is what we're dealing with. Okay, we'll go ahead and adjust. It's like being a professional athlete. Like, if Michael Jordan went down 27 points in a basketball game, you think he was panicking? No. It's like, okay, this is what we got to work with. We got a 27-point deficit here. Like, we're going to figure out our way to climb back from this, right? That just comes with experience. And so just understand, for all you newbie investors in your first few years, man, like, this is just part of the process. Like, you just got to be stoic in this game and, roll with the market. The market's a roller coaster. There's a lot more fun times than bad times, but it's a roller coaster ride, right? 2, all stocks I love buying right now just got way more expensive. I like to buy my stocks for as cheap as possible. That is such an important point I make right there. Listen. For me, I'm constantly buying in the market, right? I'm buying every single week. And as everybody watching this video right now, you should be buying stocks at least every 2 weeks or at least once a month, okay? But you need to be buying stocks as actively as possible. And if you work a job, you got more income than expenses, which is what every single person watching this video right now should have, more income than expenses. You need to be buying stocks as actively as possible all the time. So given that I'm consistently buying stocks all the time, I want to buy my stocks for as cheap as possible. I mean, at the end of the day, if I love AMD, why would I not want to buy AMD for $1 instead of $87? Like, I could get a lot more shares at $1. I would love to buy Amazon at $1 instead of $180. It's a very simple game. I want to buy my stocks that I love for the long term for as cheap as price as possible. Why? Because I get to buy a lot more shares, 1. 2, I'm going to make a lot more money long term. A lot more money. That's very important. 3, said many of the largest upside moves in the stock market history occurred during bear markets. Gains come and go. Oh, is that very evident today? Okay, and I'm going to show you in just a moment. We're going to go through some of the biggest gains in stock market history and where the market ended up going over the next few weeks or next few months, okay? As I hope all that makes sense on why I wasn't popping bottles of champagne today. Have a great day, right? That's why you didn't see me out there celebrating, going crazy. Oh my gosh, we made so much money. At the end of the day, this is just part of the process. This is just part of the process, man. I celebrate over 5 and 10 year spans. Other people celebrate or get freaked out over 5 and 10 day spans or 5 and 10 week spans. Like, it's nothing. Next up here, I posted this on my X. By the way, if you want to follow me on X, I always have it linked in the description area of all my videos. So if you're active on X, formerly known as Twitter, you can certainly follow me on there. I've been posting a lot on there recently. So rule of thumb, always load up on stocks when the put to call ratio is 1 or above and the VIX is 50 plus. Doesn't mean you'll get the absolute bottom of the market, but you're getting close. Has never failed in 40 plus years, right? Decades and decades and decades you can go back. It never fails. And so if you're thinking like, okay, put to call ratio is over 1, VIX is 50 plus or 30 plus, 40 plus, whatever, right? I'm going to get the absolute bottom of the market. It doesn't work like that. It doesn't mean like today I'm going to get the bottom, but you're getting pretty dang close every single time. And I can take you back through every single time period. For, over the past many, many decades, go back to even before I was born, never mind before I was in the stock market. Every time you see that put to call ratio go crazy and the VIX spike insane like that, it's a huge buying opportunity. Huge buying opportunity. That's what we're witnessing right now. Doesn't mean you're going to get the absolute bottom on the market, and you don't have to. Like, you got to understand, when you're buying in a crash, you're getting such attractive pricing on stocks, you don't have to worry about getting the absolute bottom. It's irrelevant. Listen to me. It's irrelevant if you get the bottom when you're in a crash. All that matters is you're buying, because you're likely getting stocks at year or multi-year discounts. 3-year discount, 5-year discount, 7-year discount, 10-year discounts. And that only happens once every 10 years or so. And so you don't have to get the bottom. You're going to make so much money over the next few years as long as you're just buying along the whole crash. And then as you come out of that crash, you keep buying. You keep the pedal to the metal. That's all that matters. Whether you get, if you're trying to buy Amazon, whether you buy Amazon at 160 or 170 or 180 or 190 or 200 or 155, it doesn't matter in the end. All that matters is you were buying Amazon during this crash. Same thing with the 2022 crash. Same thing with the 2020 crash. Same thing with the 2018 crash. Same thing with all the corrections we had over the years. Same thing with 2008, 2009. You didn't have to buy right at the bottom. I got it right at the bottom. I bought March 2009. No. All that matters is you were buying that whole crash and you bought the way up. You made so much money. It was ridiculous. So much money. Incredible amounts. Like you were such a happy camper 5-10 years from then, right? Like, oh my gosh, if you were buying the whole great financial crisis crash, right? You were buying that whole thing. Do you know how happy you would have been by the time you got to 2018, 2020, nowadays 2025? Even with this crash, look at where stock prices were then versus now. Okay, so that's very, very important here. Alrighty, now next up here, I want to show you something very important. So what we're looking at now is the list of the largest daily changes in Nasdaq history for up days. Okay, so what we find is the second best day in the history of the Nasdaq came yesterday, right? 12+% move. Now the best day in Nasdaq history was January 3rd, 2001. Now, the question is, was that the bottom of the market, right? So let's go ahead and take a peek here. And what we find is absolutely not. Absolutely not. The fact is, 9 months later, the Nasdaq was far lower. You know, at that particular time, Nasdaq was around 2,500, and here it went down to 1,500. Now, I also love to look at the Nasdaq from back in that time range, just because, to be quite frank with you guys, the Nasdaq was a joke back then. The Nasdaq was a speculative hot mess. It's not the Nasdaq it is 25 years later. No. The Nasdaq of nowadays is built with a bunch of massive beast companies that are insanely profitable, great margins, recurring revenue streams, you know, the strongest of the strongest companies in the world. The Nasdaq back in 2000, 2001 was not that. It was a speculative mania, like, you know, a la like a lot of crypto related stuff nowadays, right? Where it's like, oh, it's going to be big someday. A lot of people are going to use this token, blah, blah, blah. But it wasn't like all proven out yet, right? So that's the Nasdaq back then. But the moral of the story is here, you had that massive upward day and you still ended up going down quite a bit after that, right? The next biggest obviously was yesterday. Then from there, we had some incredible dates here, right? We already looked at the 2000, 2001 kind of time frame, so we don't need to look at that. So you can look at 2008, right? October 13th, 2008, Nasdaq had its third best day ever. And the fifth best day in the history of the Nasdaq was right here, October 28th, 2008. Nasdaq was up 9.5%. So what about in this situation? Well, that's basically where the market was at that particular time. Let's call it 1700 range on the Nasdaq. And ultimately, Nasdaq did go down. Went down to, at the lows, you know, we can call it in the 1200 to 1300 range, right? Now, keep in mind, it was only down at those ranges for a very short amount of time, kind of in that November 2008 timeframe, and then around March. So it wasn't like it was that whole time, because even here, Nasdaq's kind of 1500. But the moral of the story is here. On those days, it didn't mean like you were at the exact bottom, right? Many of the biggest rallies you'll ever see in stock market history are during bear markets. It doesn't mean you reach the bottom on the market, okay? So the moral of the story is you see a day like yesterday, people are saying that's the bottom. Doesn't mean it's the bottom. Could be, but it doesn't necessarily mean that at all, just to be quite frank. We could easily go down and actually create new lower lows. And it's very disheartening for a lot of investors that assumed we were at the bottom or got very emotional about it. Now, next up here, very important I show you this. This shows you if you just miss, because some people, when you're in a market like this, they start thinking they can play a timing game. They start saying, oh, I'm going to buy in at this time and get out this time. So what happens if you just miss a few of the best days in the market, right? Because we know you're not going to be able to time this out perfectly and call the market on a day in, day out basis. No one can call the market on a day in, day out basis ever. No AI can do that. No one's sophisticated enough to do that, to be able to say, tomorrow the stock market's going up. The next day it's going down. The next day it's going down. The next day it's going up. No one can do that. No AI can do that. No one will ever be able to do that, to be quite frank, okay? So let's say you're not intelligent enough to realize that, right? And you think you can call the market and get in and get out and all that stuff, okay? Look at this. If you stay fully invested in the market over time, right, you go to $224,000, right? Growth of $10,000 from 1995 to 2024. Now, if you just miss the 10 best days, remember that's over, several decades, 2 decades, right? 3 decades. If you just miss the 10 best days, you have less than half the amount of money. $102,000, 54% less. And that's if you just miss the 10 best days in 3 decades. That's insane. That's insane. No, imagine you miss the 20 best days. Now you have 73% less money. 73% less money from just missing the best 20 days over that time period. If you miss the best 30 days, 83% less. The moral of the story is you got to stay invested in the market. You know, anybody that ever tries to preach against you is preaching against mathematics. They're preaching against statistics. Like, it's just ridiculous. It's ridiculous. And you know, it would be one thing if, like, there was some investor that became, like, you know, $100 billion net worth, and they were the one outcast that, like, I could always see where the market was going short term, and I was in the market, out of the market. But that's never existed. That's never happened. That's never happened. There's not one investor in history, trader we should call him, that could get in and out of the market and made billions of dollars doing that. Not one. Not one. If you want to say, well, there was this hedge fund guy and he made a lot of money and sometimes he gets in and out of the market, that's sometimes. But I guarantee you the majority of the money he made was from just holding stocks and them going up over time and from taking the 2 and 20. So there's no one that ever got some multi-billion-dollar net worth from trading in and out of the market all the time. It doesn't exist. They get rich from actually just holding great companies over time. That's how they made the majority of their gains, and from the 2 and 20 they take. And that's just facts. There's no debating that. There's not like a comeback from that. There's no debate. That's factual. And the same thing with what I just showed you. That's factual. That's not opinion. There's no argument to be made here. And so, you know, if you want to argue against math, 2 plus 2 doesn't equal 4, you can do that. But what are you in that situation? You know, just okay. Alrighty, let's go ahead and react to some videos here.
Would have made money. What are you advising clients to do now?
Well, we've been pretty consistent for several weeks. This is not a time to add to risk assets, and no surprise, this is a pivotal moment in terms of changes in global trade. When you take a step back, regardless of what's happening here day to day, week to week, what we know for sure, this is a tectonic shift in policy. Even on the other side of lowering or increasing the timeline to reciprocal tariffs, you know, there's certainty here. U.S. tariff rates are going up meaningfully to 10% minimum levels. So this is in dialogue with all of our clients, changing their perspective on markets, and as importantly, changing many of the discussions in boardrooms about how they run their businesses.
So what are your clients?
What's interesting is this sounds really intelligent, doesn't it? It sounds really intelligent. Like, you don't want to buy right now. Don't add to risk assets right now because, you know, we got tectonic shifts in global trade and all these things. It sounds so intelligent. And you know what sounds really dumb is buy because the market goes up over time. Right? But the reality is what he just laid out there is actually dumb. Sadly enough. And the one that just says market down a lot, buy, is actually the genius. It's so backwards, right? It's like so crazy. But that's the truth. The one who's willing to buy in the crashes, although there's a million reasons not to buy, and there's all the bad news, ends up being the genius in the end. And it always plays out that way. There's no other like, well, sometimes, no. It always plays out that way. There's never been a time it hasn't played out. Not one time. We go all the way back to the Great Depression. You could be buying stocks in the Great Depression, and there was a million reasons not to buy it. You end up being a genius. And then every single correction and crash ever since then, for 100 plus years, every single time you end up being the genius. And you sound maybe not intelligent at the moment, but you end up being the most intelligent one in the room over time. And this whole like, well, you know, don't want to add to risk assets right now. It ends up being a horrible decision, but it sounds intelligent. And so you're the man that you're the one that runs you're the head of wealth at Citibank. Shoot, you know, you got it. It's more important to sound smart than be smart. Let that sink in. Rewind that if you need to hear that again.
And how is this all impacting them? Are you seeing margin calls, for instance?
Well, this is, we've certainly, in alignment with other banks, we've seen margin calls. They've been well managed. These are margin calls that, have not been a surprise to us. Market activity has been, despite the volatility, relatively orderly. Markets have been well functioning. We feel very good with the advice we've been delivering here in terms of caution, because in the intro you talked about how difficult.
Yeah, but there's also been some sketchiness on some things that have been going on in regards to the market. Like today, from what I believe happened, I believe the S&P 500 hit 7% down. Yet the circuit breaker didn't hit because I guess it wasn't there for a minute or something like that. And suddenly the market just goes back up and up and up and up and up from there. It was very strange. And it just kind of made you think, like, who's playing around with things? Did the government just put in a big buy order because the circuit breaker was about to hit? Was some big dog hedge fund investors? Like, who did it? Like, it's very strange that it got down to the exact level the circuit breaker would hit, but it wasn't quite there long enough for the circuit breaker to hit, because let's be honest, when those circuit breakers do get hit, it creates a lot of panic in the market. It actually panics people more when circuit breakers start to get hit. They get freaked out more, not less. So the headline today is not that circuit breakers got hit, but it's very strange that the way things
any
reacted.
of us to pin down macroeconomic implications of these policies. And when you bring that down more to the corporate level, there hasn't been time for the sell side to update estimates in terms of earnings for most corporates. And you've seen, very limited adjustments in terms of guidance coming from companies. We saw guidance pulled by a few U.S. Corporations yesterday. Investors aren't going to get clarity until we get into earnings season tomorrow and over the next several weeks. And I think, for investors, it's hard to know whether this market at any given point right now is cheap or expensive. We're watching prices move, but we don't really know in a PE ratio what's happening to the E.
So it is difficult to tell. I mean, there's so much uncertainty still. But in terms of asset and asset classes, is there one where you've changed your views on, given the last, developments in the last 2 weeks?
Well, I mean, we have even more focus on some non-correlated assets, as you might expect. With our clients, we're once again, with volatility like this in the markets, their interest is in hedge funds, and so we're seeing increased investor focus on hedge funds. We're also, of course, seeing clients who may have a directional view on markets also want to build some protection. So structured notes right now are central to a lot of client dialogue that we're having. We really want to keep our powder dry at this point in markets. Our Chief Investment Officer, Kate Moore, a very well-known investor, reminds us frequently, sometimes as hard as it is, you're best positioned as an investor to, not do a lot in the moment, not overreact to headlines, particularly at a time where it's difficult to have conviction when you really don't know what's occurring with fundamentals.
Indeed, to your point about, kind of reassessing things as they go along, we're seeing U.S. futures declining, so reversing what we saw overnight.
When you're in periods of massive uncertainty, there's never been one where it wasn't a buying opportunity. Doesn't exist. Massive uncertainty means massive deals on stocks, which means massive amounts of money being made over the next few years. It's as simple as that.
Sense of what we've seen in the past couple of days. Is it a sort of clearing event, or is this a new normal?
Well, it's hard to call anything in the last few days normal. What we're seeing is, in many ways, for those of us who have been through cycles, we're seeing, kind of a classic shock factor that markets have when news like this comes on the scene at a magnitude we've never experienced. I think what we know for sure, we've passed peak shock. The world now knows this tectonic shift is happening. What we can't know yet is the way this is going to flow through to economic activity, corporate earnings. We saw Some parts of our investor base react very quickly across Citi. Obviously, hedge funds were moving even before last week's announcement. Real money investors moving a little more slowly. I wouldn't say that we've seen wholesale selling of equities in U.S. retail yet. That takes a while to unfold, particularly given retirement plans in the U.S. and other more stable pockets of U.S. equity investment. So this is, we're in a different phase. And, I would say to investors who are thinking about, entering these markets, do so with caution and discipline, have a core asset allocation that's set. And to the extent you do want to, try to be in and out of this market, have it be very thoughtful, a limited amount of your portfolio and, with appropriate order management, hedges so that, this market doesn't run away from you, because we're seeing, again, swings that are 9 sigma events yesterday in the U.S. market.
So that's for U.S. stocks.
Yeah, I mean, if you're talking about, some big legs lower from kind of, let's call it more retail related money, it'd be situations in which like people that are around retirement age or are retired become convinced that the stock market's going to be down for years to go in the future. And so they sell out of their portfolios and just go to cash or put it in treasuries or something like that, right? That could put an immense amount of selling pressure if, baby boomers were like convinced of that or something like that, right? Other thing that can is if you get big unemployment cycle, because that's one of just many reasons why the stock market went down so significantly in 08, 09 was unemployment spiked massively, right? When people have their, are losing their jobs, naturally they're gonna, if they don't have emergency money around, which a lot don't, unfortunately. So where do they go to pull money out of? In that meantime, it could be a month, it could be many months, during the great financial crisis, some people were in between jobs, 6, 12, 18 months. So what do? A lot of them sell their stocks, right? They sell their portfolio and they use that as an emergency money, which just puts a lot of selling pressure on the market, right? Because if, Randy has $80,000, in the stock market, you might not think that's not a big number, right? But there's a lot of Randys out there when you're going through a big unemployment cycle. And if they're all going to the exit doors at the same time because they're all losing their jobs, right? Big selling pressure. And then you don't have that much buying pressure on the other side because you're going through a crash and you got guys like this, the head of Citi, who's saying don't buy, right? And you got people all uncertain and already looking for that confirmation bias why not to buy. And so then you just get this insane selling pressure, which pushes stocks down to just, ridiculous levels. That it's like, how are these stocks trading down here? How are these indexes trading down here? And those sorts of things, right? So it's just some stuff to keep in mind, okay? All right, let's get into big tech next. And then we're going to get into this last one, which is around financial crisis and recession.
Technology stocks are coming off, of course, that rally yesterday, historic rally. This morning, Andy Jassy affirming that the AI spending at that company is going to continue even as tariffs raise potential supply chain concerns and expenses. Deirdre Bosa has more on today's Tech Check.
Very important. I say this right off the bat in regards to this. This is phenomenal news for companies like NVIDIA, companies like AMD. I mean, because this is one of those time periods and there's so much uncertainty. People are like, what if the big tech companies cancel all their chip orders, right? With NVIDIA and AMD and these sorts of companies. A lot of people worried about this. This is very impactful for positive.
Hey, good morning, David. So remember his comments too. They follow Sundar Pichai yesterday, also reaffirming Google's CapEx this year. Bigger picture is that amid the tariff volatility of the last week or so, the message on AI has been consistent. This is optional. This is not optional. It's existential. We've heard from tech leaders from Google, Sundar Pichai, to Shopify's Tobias Lütke, now Andy Jassy, in that Amazon annual shareholder letter, reiterating that this is a once-in-a-lifetime opportunity that must be seized aggressively through deep investment and full-stack integration, making AI more than ever an easy and obvious contender for Amazon's fourth pillar, that is businesses that signal where Amazon sees durable growth and where it's willing to bet big for the long haul. Yet Jassy stopped short of naming it in his latest annual address to Wall Street. Amazon's first 3 pillars, they are Marketplace, Prime, AWS, massive defensible businesses that drive consumer growth and customer loyalty. Now, leadership has been searching for a fourth pillar for at least nearly a decade. Back in 2017, when I first attended an Amazon AGM, Jeff Bezos declared that they were hard at work finding the fourth. Then again, during his last shareholder meeting as CEO in 2021, Bezos said they were still looking and there were a lot of contenders, but that the bar was extremely high. And it's not that Jassy isn't contemplating it. In his letter last year, Andy Jassy called out Gen AI as the next primitives or foundational tools core to Amazon as a whole. Since then, Amazon has gone deeper into the AI stack, more workloads on its custom AI chips, continued infrastructure build out, its own foundational models, and the app layer soon as it gets ready to roll out an AI revamped Alexa voice assistant. Now, in owning the full stack, Amazon's strategy, it's starting to resemble Google's, which is seen as further ahead in the race. So as tariff whiplash continues and it hits Amazon's largest marketplace pillar particularly hard, investors, they could expect Jassy to double down on AI, calling it out as its fourth pillar. Guys, that would be a strong signal and maybe a missed opportunity in this latest letter. Of course, we cover Amazon so closely. We know that they have these pillars. I'm not sure how widely that is known, but it would certainly send a signal to longtime investors that it is all in.
Yeah, and advertising, which has become such an important component, that's just lumped in a marketplace, I guess. Right, Deirdre?
No, I mean, some have considered and that that advertising could be that fourth pillar. It's just grown so much. Prime Video could be another one. And, you know, when Bezos was asked about this during his last AGM, he raised video as a possibility, some others, but it just feels like since 2021, AI is the thing that runs through all of the businesses that is powering advertising more than ever. The other pillars that it seems like an easy one where Amazon could get out ahead because, I mean, in tech circles, it is still seen as sort of playing catch up to some of the other mega caps and AI first companies in the space.
Okay, Deirdre, thank you very much.
Yeah, I mean, Amazon, steal deal here, you know. Every single correction crash, Amazon's always a steal deal, and this is just another one.
To start here, Josh, where we are now, because the damage that the president and the administration have caused to all of this doesn't just reverse in a day. And I think you're starting to see some of that. We still have tariffs, big ones on China. They're going to hurt growth. And that's why recession possibilities are still as elevated as they are. What do you see?
I think this is like the aftermath of yet another bear market bounce. And these things are mentally debilitating for investors precisely because of how quickly they slip away. Yesterday is the 10th best day of all time for the...
They're only very hurtful and demoralizing to investors if you're getting caught up in all the emotions of like, oh, we hit the bottom, oh, the market's up, so we hit the bottom, like, you know, and all that crap. As long as you're taking the standpoint of, hey, I want to get as many great deals on stocks for as much as possible in 2025 because I'm going to be buying this whole year. Like, you're not getting caught up in all that, right? It's only the people that are hoping for a bottom right now.
P500. I heard that breathlessly reported everywhere. I saw the tables, all the graphs, all the charts. What didn't necessarily accompany that commentary was the context in which we've seen the other 9 best days of all time. And I'll spoil it for you. Typically, they take place in years like 1933 and 2008 and 1931. And they happen when the market is in a 75% drawdown. A 48% in October 13th of 2008 was the 6th best day ever. We had a huge 11.6% run. We were already down 35.9% from the high. Yesterday is peculiar in that it didn't take place in a statistical bear market down 20% or worse. It's a little bit shallower than that. But from my perspective, close enough. Horseshoes and hand grenades. The median stock was in its own bear market. Most sectors that matter with market cap were in their own bear market. So what happened yesterday, while it was exhilarating and remarkable and a lot of fun and a lot of backslapping and a lot of rich kids who are really proud of themselves because they grew up insulated from the consequences of their own actions, the end result today is, oh, wait a minute, maybe we put the financial crisis on hold, but we still get to have a recession. So that's how I feel. And I don't want to get too negative. I'm not out shorting the market. I'm not a hedge fund. But I just want to give people a really accurate picture that this feels more to me like a classic bear market than it does a correction or a dip or a quote-unquote healthy pullback.
Yeah. So, Steph, the VIX, which was at 50 yesterday and then got a lot of air taken out of that balloon, is on the rise again by a lot. It's at 42.5. It underscores, where we are. I thought Sarah's point was important, too, at the end of the prior hour. It's the dollar's worst day since 2022. The typical safe havens have not been such. Dollar bonds, munis, for example, which a lot of our viewers, I'm sure, are invested in. I'm wondering what you do in an environment, as I said, the damage that was caused here, the self-inflicted damage that was caused on these markets doesn't reverse in a day.
It definitely does not. There's still a lot of skeptics out there. I didn't see anyone really reverse course that was negative, that went to positive. Numbers are coming down. Estimates are being reduced. They have been for a while. Target prices are getting cut. This kind of after the fact, Scott, to be honest with you. Look, it's not often. And in fact, in 33 years of doing this, I've never been up 9.5% in a day. We know the long-term total return in general for each year is 7.7%. So yesterday was great. I'm not in the recession camp. No, I'm just not. Not with the weekly jobless claims where they are, and you're at 220,000 on a 3-6 month basis. Recession is 350 to 375. Inflation is coming down, not to the 2% we needed to, but it's coming down.
CPI report was really good.
So
and on any other day, at any...
So here's the issue about the whole recession thing. Listen, everybody's so obsessed with trying to call a recession all the time. Recession. And we just see it year after year after year after year. And it becomes much more pronounced when the stock market's in a correction or crash. And that's when people really start to question, recession's coming, we're in recession, whatever. And it's hilarious. Like, people are so obsessed with, the recession call. And it's like, we'll see. Let it play out, man. Everybody was convinced we were going to have some sort of major recession. 2023 never came. Like, come on.
I know.
We'd be like, this is exactly what we've been waiting for.
But maybe, just maybe, we start to make good progress on inflation, and then maybe you get the Fed conversation back. I don't know. I don't think we're going to see 100 basis points of cuts, but maybe if we keep getting inflation down, that is a good sign. So I am just not in the camp of recession. I'm in the camp of slowdown. I'm in the camp of, are we flat? Are we up 1%? Okay. Now I want to hear what companies have to say in terms of earnings. Numbers, again, have been reduced dramatically. The stocks are down dramatically. I want to see how they respond tomorrow, starting tomorrow.
You can't expect.
If they cut, how do the stocks react? That'll be very telling to me.
I know, but you can't expect, can you? I should ask you rather than make a declarative statement. Can you really expect that these companies who have absolutely no visibility whatsoever are going to give any kind of guidance on any level that sounds good? If they even are able to give guidance at all.
No, but I got stocks down that are 25-30% into that.
I know, but if you're having a recession, they may not be down enough.
But I'm not in that camp. I'm not in that camp. I just told you why. I'm just not. But I have stocks that are down a lot into the print. So the expectations are very, very low. And what is very clear is that Trump and Bessent are watching the bond market. You lose the bond market, you're going to lose everything. And that's why they actually reversed course yesterday, in my mind.
Oh, it's clear that, the bond market's, ruling the day. We learned the lesson of how powerful the bond market actually is yesterday. Some comments from Jamie Dimon talking about recession apparently swayed the president as well. But again, I just look where we are at the screen. You can't normalize in any way what's taking place. Yesterday's rebound wasn't normal, and this activity today, down as sharply as you are, as I said, you got a lot of problems to deal with that were self-inflicted. Business has no confidence in their ability to see anything, okay? The fog may have dissipated just a little bit yesterday, but it's still nasty out. Consumers, do you think they're looking at their investment accounts, their 401ks, 529s, pension funds, and feeling great about going out and spending money now?
Yeah. So, we all know we're a consumption economy. That's 2/3 of GDP. And so consumer sentiment, you can say it flips on a dime, which it can, but it definitely, especially with the unrest, can become a self-fulfilling prophecy on top of CEO sentiment. And it's just hard to believe that we're on the precipice of earnings seasons. And I think every company is going to come out like Delta and say, I don't know. I don't know guidance. How can you say that with a straight face as a CEO? And I think the banks will be really interesting because they're at the epicenter because they have how much are they going to spend, M&A, et cetera. And so I think we're going to continue to be in this, I still think this 2018 environment on steroids. And if you go back to 2018, you had 8 drawdowns between 8 and 15%. Half of those drawdowns were between 10 and 15%. And I think what other, nugget you have to sprinkle into this is that.
So before she goes further, I just thought of this is going to be a huge earnings season for a very specific reason. Okay, listen, and it has nothing to do with, listen. This is a very important season to see who are really the best of the best companies out there. Because the best, safest business models are going to be able to give guidance. Are going to be able to say, we think we're going to probably do this number to this number. You know what type of companies are probably going to do that? A lot of companies that have recurring revenue streams, recurring revenue business models, right? They're going to be able to give a guidance and feel comfortable giving that guidance. You'll find out the weaker businesses and the weaker business models because they won't give any guidance. Or if they do give guidance, it's going to be a massive range. But a lot just won't give guidance. That's a sign of definitely a weaker business. It doesn't mean you can't own those businesses or you can't own those stocks. It's just understand they're weaker. But if a company can give a good guidance and feel comfortable giving that guidance in this market, in this environment, which is the most uncertain we've seen certainly since 2020, that's a pretty dang impressive sign. That's a very impressive sign. That means like that company has a very special business model. Very special.
Is not going to come in. There's no Fed put here unless, let's say, something breaks, but there's no Fed put because they're not going to be contra to a strategy or tactics they're not aware of.
No, but if, people were speculating yesterday who just watch markets well, like Mohammed El-Arian, for example, who joined me on Closing Bell, that in his mind, the Fed wasn't that far away from having to do something. Whatever the something is, that's not a bullish environment.
Stabilizing the Treasury market is historically not bullish. Yeah. I would also point out that 45 basis point swing in the 10-year is maniacal. Like, this is not... Again, I want to say, it's a pullback. Just pick your favorite names and load up. I think you should be a buyer if you have a really long-term time horizon. You should not expect that the buys you make today will necessarily be rewarded a week from now. It's just a different 100%. Environment. A 45 basis point swing in 3 days is the most that we've seen since 2022, which is another legit bear market. We've only seen that 7 other times going back to the year 2000. And on every single instance, the S&P was down 25% or worse. That we've seen that. So again, that is a classic feature of when the S&P is down big. You get those huge swings in the 10-year. Now, I want to take it a step further and say, okay, great, we have the carnage.
Yes.
I just don't know if it's gone on long enough to really register.
You've got the market down 15% from highs, 18% for the Nasdaq. You've got stocks that are down 30, 40, 50% from their highs.
Agreed.
So I would say, there's things to be concerned about, but you've got to look at opportunities for the long term.
But here's the problem. Then so you buy a stock 35% in the hole, come out with earnings not as bad as feared. Maybe they even give guidance. 43% of companies in the S&P 500 give sequential guidance, so that would be great. And then the stock rallies by 10%. You say, I made a great buy. And then a week later, it's rolling back over lower lows. This is the main concern right now, I think, amongst Wall Street strategists. It's not, are these stocks compelling values? It's, is there a trapdoor in what looks like it should be the low?
So, I think it's very important I say this, right? I need to echo what Josh Brown said there in terms of, if you're buying a stock today, don't expect to make money on it over the next week or the next month or the next quarter, to be quite frank. You never know what can happen here. Now, how do you continue to get a stock market to continue to crash significantly from here? Not just like volatility, like up a day, down a day, and it just kind of stays in this range. How do we get a Nasdaq to go to 14,000 from here instead of, 16,000 where it's at, right? How do you get a stock like Adobe to go from 340 to 240 or to 280 or something like that? Now what you need is another huge bad thing to come out. The first thing that really got this market to go down was tariffs, right? Second thing that got to go down was, oh my gosh, the tariffs are way worse, way more extreme than anybody anticipated. Boom, next leg lower. So how do you get the next leg lower? Now you need something really bad to come out. Inflation spike huge. It doesn't look super realistic, but if that happened, that would freak the market out. Probably not happening though. A recession, like more recession signals. So like a really bad jobs numbers or some really important big companies to announce they're doing major layoffs because of the tariffs or something like that. Stuff like that could maybe give the market like a next panic of like next leg lower. China unloading treasuries, right? And let's say the 10-year spikes up huge again. My gosh, that would freak a lot of people out in a significant way. If all of a sudden you saw that 10 years starting to move up toward 5%, whew. And then you have some very important individuals at the Fed come out and say, they're still not in any mood to cut rates. Like, you need more significant, scary stuff to happen to get the market to crash further and further from here. You can't just have the same, because we all know about tariffs now. So you're not going to go down on tariffs anymore. We already know about that. That's done. Now you need something else big. Does China go into Taiwan, right? Okay. Then that's the next big leg lower. You need more big events to continue to get the market to freak out. And so that's an important thing to understand. If you don't get that, then the market will start moving up. That's just what happens. If you stop having a next new big event that freaks everybody out and says, oh gosh, I know I'm already down huge on the stock, but I got to go sell. If you stop having those, then the market starts to drift higher, and the market starts to come back. And everybody's like, whoa, geez, the market just went up 10% in the past 3 months. Like, oh, that's interesting. Like, and it sneaks up, kind of underneath everybody. So important to say that. All right, guys, appreciate you joining me as always. Thanks so much for being here. Pin comment down there if you're looking to apply to join my private stock group, private wealth group, get access to my private Discord chat, access to 1000xstocks.com, the premium software I use on a daily basis to figure out if I'm getting great deals on stocks, ripped off, all that good stuff. And other than that, if you want to subscribe here to the channel, you can certainly subscribe. Much love and have a great day.